Yeah.
All right.
Got it. All right.
Yeah.
We ready to
Well,
we
people
ready
are just logging in, so I give
All
it a
right.
few minutes. We said 12:15, but you know,
a late arriving crowd,
well, they were right.
like they have at Dodger Stadium,
Well, yeah.
where Brad is, our moderator. So you want Brad to kick this thing off and get rolling? People can jump in when they get here.
That's fine. We said 12:15 to
Let's go.
12:45, 1 at the latest.
Yeah. All right, let's get moving. Brad, there we go.
So we're going to get underway here, and to all of you who have joined us, thank you. We're going to spend the next 45 minutes, and we're going to have a lively discussion on the topic of tax preparation versus tax planning. And even though those words sound like they're interchangeable, the difference can mean thousands of dollars in savings or losses, depending upon how you respond. So we have here with us today Dan Friedman and Brian Beck. And guys, I just want to open this up and ask you the straight up question. What is the difference between tax planning and tax preparation? Dan, I'd like to ask you to go first, please.
Well, obviously one is accounting for things that have already happened. Tax preparation, which is very important. No one wants to get a phone call or a letter from our friends at the IRS wondering why they've got information that doesn't add up on your tax return. There's significant complications to your finances if you don't square up on April 15th. So tax preparation is something that folks need to have a firm handle on come April 15th of 2023. That is when the books for accounting for 2022 end. Tax planning, however, begins at January 1st of 2022 and then ends hard stop December 31st of 2022. So a lot of folks conflate the tax preparation when they sit down with their tax preparer, accountant, or TurboTax to do their taxes, thinking that if there was something that can be done to reduce their taxes, they would do it then. And that is, 97% incorrect. There are a few little things that you can do after the calendar year. So I think that would be the main thing. And there's no planning that has gone on.
Yeah, and to add on to that, I think if you talk to any professional that does taxes or is involved with tax planning, most tax professionals, you can't talk to from February 15th to April 15th. And then if you want to talk to them now, they're probably on the golf course if you're down in Florida, or the ski slopes. Now they got some snow out in the Midwest. But for us, this is the busiest time of the year. This is crunch time for people that really do tax planning, because we're meeting with the small business owners last month, this month, and really the individuals start probably about now until the middle of December, because your tax planning, depending on the sophistication of your return, to do it to some really deep dive tax planning for small businesses probably takes a good 2 or 3 weeks. Individuals, it's 1 or 2 phone calls to really rectify what you need to do, before the end of the year. And I'm sure, just like our CPAs, everybody's probably getting their letters from the people that do your taxes. Oh, look out for this, look out for that. You should be doing this, you should be doing that. And that's really not tax planning. That's a CYA, cover your ass, that you're actually showing your clients that you actually care about them and doing something. Tax planning really is picking up the phone, calling your client and saying, okay, if it's an individual, let's have an hour discussion. What's going on? Tell me about your cash flow. Send me your pay stub. Let's see what your year-to-date capital gains are. If you work for a public corporation, what are your options? What's vested? What's in the money? IRAs, should you be converting some to a Roth IRA? Gathering that information. And then a second phone call or a Zoom meeting like we're doing today to actually give actual ideas to say, this is what you need to be doing, not some 10-page letter you get from your CPA. Oh, here's 20 different points you should do at the end of the year. Well, how do I know which ones are right for me and which ones aren't? Because that's what a tax planner does. The tax planner says, don't even read that stuff. That's my job. I will tell you what you need to do and how much you have to save. And like our software that we have, just the other day on a call with somebody who was out in Hawaii just about before they were going surfing, we sat down, crunched the numbers, figured out exactly to the penny. All right, if we do this, that, and the other thing, this is what you'll owe. Went through 2 or 3 different scenarios. We chose one of them and we were done within an hour and he went surfing. So
I've heard you use the analogy of the difference between tax preparation and tax planning being tax planning is driving from point A to B, looking straight ahead and having a GPS navigation system. Doing it with tax preparation is like trying to get from point A to point B using your rearview mirror. And I thought that was a pretty apt description. Can you elaborate a little bit upon what you mean by that?
Good, yeah.
Yeah, sure. The tax plan takes into account construction tolls and how to avoid them. So again, starting at the beginning of the year, and depending on the complexity of the tax circumstance, it can actually be looked at every 90 days. And one of the things that we've been doing recently, at least in the third quarter, is looking at maximizing the opportunities that exist, taking passive tax losses with the decline in the market, and information and technologies leveled the playing field for what we consider middle-class millionaires, where you can go ahead and in a relatively short amount of time, using technology, take a loss, but still maintain your exposure to that sector, or even that particular stock. If it's healthcare, you can buy a basket of healthcare, take a loss, which is then deductible or offset against gains going forward. Also coordinating that for small businesses to maximize some of the tax benefits that are left over from COVID that are going to expire at the end of this year. Things like 100% deduction for equipment that you put into service. Now you have to have the money, you have to have the cash flow to withstand that. You don't want to be broke at the end of the quarter to save, at the end of the first quarter next year to save some money in taxes. So I think the having a ways, if you will, for taxes to say, wait a second, no, we can't go in that direction. There's a 2-mile backup would be analogous.
Okay, that makes good sense. So we're in November already. We've got only about 6 to 7 weeks left in the year. What are some of the things that you are doing with your clients now to avoid that unpleasant surprise that may occur as you roll into the actual tax preparation season.
Well, as Brian said, and I'll kick it over to him, is one of the big things that we've always done. And there was one of our most viewed podcasts was how to avoid the triple whammy, something that Brian coined. We want folks to know where they're going to land. So it's not this conversation of how did I do? So we're doing with the last 6 weeks saying, okay, where are you going to be come April 15th? If there's a significant refund that's coming in, then maybe there's some things that we can do to have less withheld, maybe skip a tax payment estimate that you've been planning on doing. And being prepared on the other end, if you're going to owe money, where's that money going to come from? If you're counting on the stock market bringing you from here to there in the next 6 months, well, that's a hopeful approach, but hope is not a strategy. I am hopeful that we will be significantly better in 6 months, but I'm not counting on it to pay my tax bill. And so that's, one of the big picture things. The other things is there are hard deadlines at the end of the year. In Connecticut, a 529 college education, and it doesn't have to be used for college. It can be used for qualified educational expenses starting as early as kindergarten. A married filing joint, $10,000 contribution, and that can go right into the stable value, could be part of your cash on hand strategy. You can get up to a $700 deduction. You go online, CT Chet, whatever it is, call up your financial gal, and I'm sure she can go ahead and take care of it, but it's a do-it-yourself thing. Where are you going to be as far as 401k contributions, things like maybe taking advantage of the downturn in the stock market, converting something to a Roth. It's not an all or nothing. So let's say you're down 15, 20%. You convert that, you expose it to tax, you make sure that you're not paying more tax than you otherwise would this year on your income. And now that money, when it recovers, is not subject to tax later on. So there's many strategies. Again, though, it is not effective if it's a siloed approach. Meaning, how does one thing connect to the other? And Brian, why don't you pick it up from here? There's many WMGNA-isms that you've coined, and one is your taxes affecting, what is that
your
saying?
Your taxes affect, everything you do, and everything you do affects your taxes. And I think people subconsciously just watch the news and say, oh, that makes sense, with what went on in the last 6 months. One of the big things is, oh, I own Facebook or Meta, what it's called right now, or I hope you didn't own FTX and you lost all your money. So you're looking at things from the stock market perspective, and people aren't putting everything in. The account's down, like you said, Dan. Should I be converting to a Roth IRA? Should I not be? We talk about the double or the triple whammy. And really what that is everybody got hit with that, a lot of people last year, which is what happened was in 2021, short story is that most money managers sold a ton of investments in 2021 in the first quarter because they thought COVID was coming back, and it never did. And the stock market raged on, and all of a sudden people ended up with 30, 40, 50, hundreds of thousands of dollars of capital gains they had no idea that they were going to get. And all of a sudden it's February of 2022, they're getting their 1099s, and they give it to their accountant. They say, well, you got $150,000 capital gain. What? Yeah, you owe $30,000 in taxes. What? Oh, you didn't pay enough in, so guess what? You got to pay penalties, interest on top of that. What? Triple whammy. So you really want to avoid that, because right now for individuals, this is the time of the year you want to look at your statements, look at your capital gains, and we have the reverse of what went on last year. A lot of times this year, we have a lot of people that have losses. But if you needed to take money out of some investment accounts, some money managers, you tried to sell the winners and not the losers. So you may still have a capital gain. Do you? Don't you? Look at the numbers. And then if you do some tax loss harvesting to, draw down on some losses. And if you did own Meta, and you said, you know what? I don't like them anymore. You know what? I'm just going to take the loss, and it's more than $3,000. You know what? You can carry forward those losses until you have gains in the future. So, now is the time really to look at the portfolio, rebalance. Some situations you should be buying, some situations you should be selling before the end of the year. And like Dan exactly said, 100% right. You can't do this in a silo. It's got to be a measured approach to you as an individual, irregardless of what somebody else is doing, your brother, your sister, your aunt, your uncle, your parents, your grandparents. It doesn't matter what they're doing, unless you're in a family trust with them, or a family limited partnership, or a business with them. You really have to plan based upon your own situation. And the biggest thing I could say, Brad, right now before the end of the year, is just look at things from a logical point of view. Look at your tax return from 2021 and go down line by line and say, okay, are these changing? Are they going to be drastically different, either on the positive or on the minus, and deal with them either way? And there's some strategies before the end of the year that you can implement that will save you. And I always say, it's never one strategy that's going to save you, $5,000, $10,000 in taxes. It's a bunch of the little strategies that adds up and get you to where you want to be and save the 5 or 10 grand. So,
it's interesting. Most of us treat the tax season not unlike the Academy Awards. We wait for the evening, and then we wait for the envelope to open, and they say the Oscar goes to, and then they see where they stand. That never happens with your clients. Is that a function of the fact that you spend time during this period where you're doing your planning, so that it seems to me that your clients are never surprised? They never have those unpleasant surprise. What are some of the things that you do for your folks to kind of even that anticipation out?
Well, the biggest thing that we do, it starts in tax season, where we're not doing the income taxes. We outsource it to a CPA, but we source the documents. That's a huge advantage to our clients, because there's an intermediary before the accountant gets the actual information. We're sourcing it to make sure not that it's accurate, but that everything is there, that the tax preparer has all the 1099s. And then we look at it and say, well, wait a minute, if there's something that we didn't know about, and it comes up and you owe taxes, we could deal with it next year. And then during the year, we're constantly going back and making notes. And to be honest, our secret sauce is pretty simple. We're proactive instead of reactive in that situation.
But Brian, let me ask you this: why? Because I'm trying to anticipate the thoughts of our listeners right now. Why don't most tax accountants or CPAs, why aren't they on the phone with their clients now saying, hey, come on, fellas, it's tax planning season? Why do they wait? That's the first part of the question. And the second part of the question is, if we have listeners that don't want to treat their taxes as if it's the Academy Awards, what can they do now to get in front of that?
Well, the first thing is, and I'll at the end of the second, is subscriptions. I mean, a CPA, if you meet with them, you're going to get a bill. I mean, most of our CPAs, you meet with them at this time of the year, you're going to get $150, $250, maybe a $500 bill. With our clients, you're paying a monthly subscription. It's part of the fee. And so we're going to call them. So most CPAs are like, listen, if the client doesn't call us, unless we really see something out there, and 9 out of 10 times, if you have a small business, most CPAs are reaching out to those small businesses. But the individuals, usually if the individuals aren't saying, hey, listen, I want to save money in income taxes, you're pretty much on the back burner for a CPA, because, where they charge you $500 a year to do your return. And then if they meet with you in the fall, they're going to charge you $250. And you're like, well, that doesn't make sense. You charge me $250 to meet with me or talk to me for a half an hour. And then I get a bill to do income taxes of $500. The economics don't really add up. So
it sounds to me like working with your accountant, which we do and we have to, That's more of a transactional relationship that happens on an
Absolutely.
annual basis. When clients work with you, because you have this subscription-based model, which I have to tell you is quite unique, it's more of a relational relationship as opposed to a transactional relationship. Is that an accurate statement?
Yeah. Well, the most accountants, again, people we have found don't want tax planning, don't want financial planning. They want tax outcomes, they want financial outcomes. So even when you do sit down on that call, does the financial advisor or the tax advisor have all the inputs? Do they have custodial accounts showing cost basis, year-to-date realized? The cost basis will show unrealized. Where are the opportunities? Do you have everyone's a pretty good idea of what they've been paid, what they've been, well, what's withheld, where the pre-tax items are? If it's a couple, both folks in real time. And again, waiting till the end of the year just to do that, you've handicapped yourself on things that were opportunities in April. So the subscription it allows us, because we're being paid to do that. Accountants aren't being paid primarily to do all of that. And it is a timely thing. Brian and I and Chris, we can each handle 100 families under those subscriptions with the existing team that we have. So we've got, we have about 98% of anything that folks are doing that touches their money at the $5,000 level, drilling all the way down, current mortgage statement, what's out on the equity line. And many of those folks are through our strategic professionals. So they don't have to spend considerable, if any, time gathering up all this stuff, which, as Brian said, puts us in a position where we're proactive. We are able to sort of look over the horizon because we have all of the information. It's not necessarily because we've got ideas or strategies that aren't available to everyone else. It's just we've got the information without having to put out the time that you would have to do on your own, or the time that someone else would have to do to gather all this stuff.
Well, I noticed that we have just a few minutes left, so I'd like to ask one more question, if I could, please. For the listeners, because I like the idea of, it's almost like going into the cheese shop and sampling the cheese. Can we give our listeners a couple of tangible examples of what they can do right now? So that this time spent with us is of value. And of course, obviously, if they need more information or this has piqued their interest, they know how to reach out to you folks. But can we give them some pearls of wisdom to send them off with?
Yeah, absolutely. So, one of the things that, and we're doing our fourth quarter, sort of the final touches on the 2022 tax approximations, tax maximizers, maximize the opportunities that exist that touches their money. One of those things, and I always like it, is that 529. Very simple, up to a $700 tax deduction. Most people are in that 500 to 700. In 10 minutes, you transfer $10,000 into the 529. You can put it in stable value, not significant, if any, penalties if you need it later on, even if you're not using it for education expenses. Another thing is on the tax loss harvesting. It is so powerful. You're able to take losses now and then offset them against potentially not long-term capital gains, but short-term gains. If you have a small piece of your money that is in some sort of tactical strategy, or you're and I don't recommend this, I don't do this myself, but there are folks who want to do some, and Brian's done it with some success sometimes. But to offset short-term capital gains, which are taxed as income, not at capital gains, later on. Those are a couple things. The other is bunching itemized deductions, charitable contributions. If you're have to take money out of an IRA, the IRA laws have changed. So there's a bunch of tangible things along those lines. If you inherited an IRA in the last year or two, the rules are completely different. If you're writing checks, big checks for charity, and you have an IRA and you're over 70 and a half, there may be a far more powerful way to get thousands of dollars of tax savings by doing a IRA contribution to your charity as opposed to you doing it. Those are a couple of the things. Brian, I'm sure you've got some ideas too.
Right. Before I forget, if you do have any questions, there's a chat box. Please feel free to put it in there and just say it to everybody so everybody can see it. My big thing right now is IRAs, what to do with them. Whether you're under 59 and a half, over 59 and a half, getting required minimum distributions, having inherited IRAs, convert to a Roth IRA. Today, everything's about the IRA. And when Trump was president, they signed the Secure Act 1.0. They're thinking about possibly doing Secure Act 2.0 before the end of the year. They want to pass it. They want to pass it. It may or may not get passed. Who knows? But that has to do 50% with 401ks, pension plans, safe harbor, testing, IRAs, Roth IRAs, everything. So right now, it's all about the numbers. It's all about crunching the numbers. Listen, last year, if you had $100,000 of capital gains and now you have zero and you have this money in an IRA and you said, last year it stunk paying $10,000 or $15,000 in taxes, but I had the money. This year, then you can really take advantage of it. Convert some of the IRA money to a Roth IRA, pay the taxes. You get a double whammy on your side. Why? Because the market's down. You're converting at a lower rate. That means you pay lower income taxes, and hopefully your adjusted gross income will be a little bit lower. And then, as we see in the last few days, I don't know how long it's going to continue, but if it rallies and the market comes back up and you convert $100,000 today and it's worth $200,000 in 3 years from now, that's a home run. I mean, that's what really happened when COVID hit. If everybody remembers, March and April of 2020, if you didn't sell within 9 months, you got all your money back. Well, it's almost the same thing as if history repeats and you convert now and your 100 used to be $200,000. Well, maybe if you convert it and it goes back to 200 grand, remember that money now grows tax deferred. And the key is with the Roth IRA, it comes out after 59 and a half, tax free. And it could grow to $5 million. It's still tax free.
Just remember, Brian, past performance is not a guarantee of future results.
Yes,
and all of this advice needs to be, coordinated, run by your financial advisor, run by your CPA to see what, the unintended consequences, the path to hell,
right.
Financial hell especially, is paved with good intentions and good ideas.
Right. And don't get caught in the double or triple whammy. That's what we're trying to prevent. So I think with that, if you don't want to chat, you want to raise your hand or we'll open the microphones, please fire away with some questions out there in question land.
Yeah, if you're a listener and you have to scoop, you can go ahead and reach us through our website. If you do have some questions, we'll stay on for another 5 minutes. You did say something earlier at the top of our conversation, Brian, or maybe it was Dan, that you're in your busiest season right now.
Yeah.
If some of our listeners needed some help, are you able to accommodate them, or are you all too busy with your current clients?
Yeah, no, I mean, on the individual side, it definitely is a lot easier. Business wise, it'll be tough, but it would have to be a Herculean effort. Usually, I took out a couple of new business clients in October, and that was pretty, that's fine. Individually wise, like I said, the ones that we're bringing on right now, it's an initial conversation. I have a new client Thursday to do some end of the year tax planning. They're all worried. I'm like, don't worry. This is basic stuff. We can get everything we need to get done by the end of the year. We like to get it done by December 15th to give ourselves at least a 2-week window for paperwork or stuff that gets may get lost in the shuffle. So we can,
Thank you.
Yeah.
Okay. So
and anyone who is,
all you participants, we're very grateful for you coming on. We have a few minutes left. If people want to ask a question, David is our technician. He's going to help us filter those. We'll give it a few minutes to see what shows up. And if we don't have any questions, then we'll adjourn this session.
David, you can unmute yourself.
there you go. We have a question. It looks like we have a question, Brian.
Yeah, whoever's going to answer this, just please read the question first, Dan or Brian.
Okay. Brian and Dan, do you have a preferred recommended network of tax professionals that we can access with information that aligns with the information you've provided today?
Excellent question.
Yeah. Brian, why don't you?
And the answer is absolutely. We didn't get to touch upon that today. Dan, I think, briefly mentioned it. One of our real specialties is that we've been in business. I know it's tough to believe for most of you out there, 27 years. I think Dan was 18 and I was about 10 when we started it. But we've built up this network. I live in Florida. The main office is in Connecticut. We have clients in about 22 different states right now. So we have tax professionals, California, New York, Connecticut, Florida, all over that we have not only worked, but more importantly, we have vetted to exactly, Jody, what your question is, that aligns with our information. Because a lot of times what ends up happening is we'll talk to a CPA and there's a blank stare on their face. And we know, okay, this is a person that just wants to do taxes, doesn't understand the coerciveness of doing a full tax planning strategy. And we can tell right away, when a CPA understands tax planning and what we're talking about, and ones that don't. And we always look to expand our network, by the way.
And if you, right, so if you have a need for a introduction, or there's a specific tax issue, by all means, get in touch with either myself or Brian.
Or you work with a sharp tax CPA professional. We're more than happy talk with them. Like I have a client in California that I talk with their CPA once a year. So
okay, excellent, great question. Thank you.
Thank you, Jody.
You're welcome.
Okay, I think people are probably getting ready to either go back to work or start their next project. So I think we'll conclude
Or
on
get
this.
a little lunch.
Yeah.
And I want to thank everybody for their time, and we'll be doing this again. So keep an eye out. And Brian, Dan, thanks very much.
Thank you very much, everybody. Have a wonderful day. Okay.
Bye.
Be well. David, you can stop recording.